Welcome to another exciting episode of the Trading Bell. This week on the program, we shall be speaking to Charles Robertson, who is the Managing Director and Global Chief Economist, Head of Macro Strategy at Renaissance Capital. But really, let's take a quick look at Charles Robertson's profile before we get into this interview.
Charlie Robertson, a leading emerging markets specialist, is Renaissance Capital's Global Chief Economist and Head of the firm's Macro Strategy Unit. He covers the global economic themes having the greatest impact on emerging markets. Over the past 2 decades, the scope of Charlie's work has covered, among other topics, measuring democratization and dictatorship risk in emerging markets, how the retirement age rising to 67 reflects deep-rooted problems in the West, and great opportunities in emerging markets, how Africa can begin to escape the commodity cycle via broader education, key ways to examine exchange rates in emerging and frontier markets, and why emerging market banks should thrive in the long term. Charlie was voted the #1 frontier analyst in the Extel surveys from 2016 to 2019, and Renaissance Capital was the #1 rated frontier firm in both 2016 and 2017. Charlie graduated from the London School of Economics in 1993 and worked at a UK parliamentary defence think tank and a research boutique until joining the financial services industry in 1998.
Thank you, Charles, for joining us.
Thank you very much for having me on.
Well, a lot happening in the markets. If you were to just quickly give us just your opening thoughts of where we are right now, with a lot happening in Africa as well as East Africa, now that we're seeing governments have tabled their budgets, like Kenya's budget was tabled just a few months ago. And it seems to be the spending is heavily being tilted towards infrastructure. At the same time, governments are struggling with raising the requisite budget for this particular budgets. So where do we stand as a country?
On the revenues front, this is a challenge across the continent, and not just the continent. Actually, lots of lower income countries struggle on revenues. Even in rich countries, they struggle on revenues too. Our perception is that Kenya can do a bit more, but there are countries that I worry much more about than Kenya. The revenues share to GDP here is considerably higher than countries like Bangladesh or Pakistan or Nigeria. So it's just that difficult thing of trying to raise revenues without stifling growth, and that's a challenge everywhere. But we do expect more revenue-raising measures here in Kenya.
Well, so just to still stick on this revenue issue, just a few days ago, the president did sign a very important bill. It's called the Revenue Division Bill for Kenya. And this particular bill unlocks the national government to release funds to the devolved governments, that is the counties. But when you look at the biggest headache right now for many African heads of state is the budget deficit. How do you plug in the deficit? They're literally turning into the global markets when it comes to raising capital using various instruments like the bonds. We've seen Kenya floating 2 euro bonds. We had floated another Eurobond, which also was successful. But in equal measure, there's concern. The IMF is saying our debt to GDP ratios have been going up. We are now standing at about 52%. Are we chewing more than we can bite?
That is beginning to worry international investors. Or at the moment, they are weighing up the concern that in 2 to 3 or 4 years' time, the debt levels could be too high. And there could be refinancing risk. You borrow a Eurobond now, it's easy to borrow the $500 million.
Sure.
It's when you have to repay it in 4 or 5 years' time.
With the interest on top.
With the interest on top, but you could probably bear the interest. It's just trying to find that $500 million. If the markets are happy and relaxed, you can borrow again. If your debt ratios are not too high, you can borrow again. Otherwise, you're having to repay the bonds. So that's the medium-term concern. It is there. But lots of investors have a much shorter term horizon. And in the shorter term, the next 3 to 6 months, they're asking themselves the question, do I lend to the US government at 1.5% for 10 years?
Yeah.
Or do I buy a Kenyan euro bond and Kenya's going to pay me an interest rate of maybe 6 or 7% in dollars? and they are choosing that. So for the moment, with the US interest rates as low as they are, because of the global trade wars and threat of a recession in the United States, it's quite a good time for governments to borrow. It's a reasonably cheap time for governments to borrow. And as long as that borrowing is used for investment, which can produce a better return than the 7% you're paying, well, then I have to say I'm quite supportive of that borrowing. As long as you don't set yourselves up with a big hump of repayment in a few years' time, which then becomes difficult when times might be different and interest rates might be much higher.
Speaking about difficult times and, of course, being futuristic, Charles, I'd just want to pick your mind, especially now that we are seeing there's a global commodities crash of sorts, where you look at African governments being advised to diversify their economies and stop heavily relying on commodities. For example, Kenya is big on coffee and tea exports. At the same time, we're also seeing other countries like South Africa, which are heavy on the minerals. And there's this new commitment that people are being challenged to diversify. For Kenya, and of course for the markets that you have an interest in, and of course you've been following up on, what are the new trends you're seeing, especially when it comes to countries being able to stay afloat?
Well, what we're watching and what investors are putting their money into, in a big way, are countries which are industrializing, because I think everyone's can see that commodities themselves don't make countries rich, not unless you're very lucky and have a huge amount of commodities with a tiny population, like Botswana. Botswana can do well out of commodities because they export $2,000, $3,000, $4,000 per person every year. A country like Nigeria is actually commodity poor. People think it's an oil producer in a big way. It's not. Not per person. It's about $200, $300 per person of exports, not 2,000 or 3,000, 4,000 like in Botswana. So the Nigerians cannot get rich on the back of commodities. So what investors are identifying are the countries that industrialize. Countries that industrialize, take off, and do get richer, and do export a lot of value. Yeah. But they do it from factories. And Vietnam is one of the top picks in the frontier markets. Vietnam actually exports more per person than China. It's that successful. Apple is thinking about moving there. Samsung is already there. Honda is already there. Intel are making chips in Vietnam. So it's all about industrialization. And that requires, we think, the data seems to tell us, education, adult literacy of at least 70%, and it needs electricity. And the countries that have got them, they're the ones that can industrialize. They're the ones that can grow 6, 7, 8% every year for the next 20 years. And that's where investors are choosing to put their money.
Quite interesting insights, Charles. Let me also challenge you in terms of looking at the countries that have been sort of classified to be the next rising countries. We have South Africa in that bucket. We also have Ethiopia. We have Kenya. And the jewel in the crown seems to be Egypt. I don't know why.
That's a big range of countries. Where we see South Africa is stuck in a middle income trap. So they got out of poverty. They raised their per capita GDP to about $5,000 or $6,000. That's reasonable. But what you want to see in South Africa is them going to $25,000. That's not happening. They're growing at 1% a year. It's less than population growth. It's been going on for 5 years now. They're stuck for various reasons. Why Egypt is so exciting is they have the education, but only this decade. You go back 10, 15 years, Egypt didn't have the human capital to industrialize. Now it does. Its minimum wage is about $120 a month. In Europe, it's $1,000 a month. So you can go and set up a factory in Egypt, $120 a month minimum wage. Loads of electricity, good enough human capital, and plenty of labor supply. They barely employ women in Egypt. They can all enter the workforce over the next 10, 20 years. The workforce can get much bigger. That's what Chinese investors perhaps setting up factories should be looking for. So Egypt's doing great. Ethiopia is the furthest back in this story. Education levels are still too low to industrialize. Electricity levels way below what you have in Kenya. Nonetheless, the government has done a very concentrated PR campaign partly,
Sure.
but also put a lot of effort into setting up a few industrial parks, which do have some electricity, and the best of those with an education in Ethiopia are going to those places. And a few places are doing quite well, but the manufacturing sector is smaller than Kenya's as a proportion of the economy. This is a bigger manufacturing nation.
But the perception seems otherwise.
The perception is remarkably different,
Yeah.
and I do find it fascinating. Ethiopia is far poorer, with less electricity, less adult literacy, and less manufacturing. Kenya's ahead on all of these.
Well, Kenya is ahead. As much as we are ahead, looking at neighboring countries, Uganda also have oil. Tanzania discovered gas. And there seems to be a new ray of hope in these economies.
What we like about all of those three you've just mentioned, Uganda, Kenya, and Ethiopia, is the adult literacy rate. So, if I go back 20 years in Sub-Sahara, the number of countries with a high adult literacy rate were very few. Mauritius, which did get very rich; South Africa, which got to middle income status; and Zimbabwe, which was a success, but politics has made a mess of it. Tanzania and Uganda and Kenya are all now have sufficient human capital to do really well. In the short term, they'll get a lift. I mean, short term, next 3 to 5 years. You're right, they get a lift from gas, from oil. But over the next 5 to 10 years, I think all three can industrialize if the governments can more than double electricity per person. That's the thing holding back Kenya right now. This is why your manufacturing sector is less than 10% of GDP, and it's not 20% of GDP. It's a lack of electricity. So if that can be resolved in the next few years, and it's also true for Tanzania, it's also true for Uganda, you can have an industrial revolution.
Speaking about this industrial revolution, the Africa Free Trade Continental Area has been signed by a number of countries. At the same time, we are seeing what's happening in the European Union, especially now that there's talk of UK, of course, exiting.
You're trying to make me cry now. This interview could really derail.
And I just want to get your thoughts on where does this leave Africa, especially East African countries that predominantly export cut flowers to Europe, as well as what opportunities lie now that you are literally heading deep dive into Brexit?
Brexit is its own mess. For the rest of the Eurozone, which is a far bigger economy and also hugely important to all of Africa because of its size, the difficulty there is there's just no growth. Europe, the rest, continental Europe, particularly Germany, is looking like Japan, an aging society with very little growth and yes, a high standard of living. The Germans are not complaining that much. They have a high standard of living, but there's no great demand from that side. So I suspect that over the next 5-10 years, your growth story is going to be increasingly pulled by other countries. It'll be China, perhaps, buying textiles produced and made here in Kenya, because Vietnam's got too expensive and they won't buy them from Vietnam anymore. They'll be buying them perhaps from Kenya, or even India. As India gets more and more significant and moves up the value-added curve, they might well be buying more product from Kenya. So I suspect that your main trading partners are going to shift quite significantly over the next 10-20 years.
China is the big topic for many African countries right now, and there seems to be a Chinese invasion in terms of them taking up big ticket projects and of course just reclaiming their space. When you look at foreign direct investment, China is right now the single largest country that has invested heavily in Africa. Where does this leave the other big boys?
Well, what's interesting about this is why it's happening. So what happened in China in the 1970s was that the fertility rate went down a lot. The Chinese used to be having 4 or 5 kids per woman, and then it dropped to 1 to 2 kids per woman. And what happens when your fertility rate goes down? When you've got lots of kids, you've got no spare money.
Yeah.
When you've got a
disposable income.
Exactly.
Yeah.
When you've got 1 to 2 kids, you have some spare money, and that goes into a bank, and your bank deposits start to grow. And in China right now, their deposits in the banking system are 150, 200% of GDP. And their GDP is massive. So we're talking trillions and trillions of dollars of cash sitting in the Chinese banks. What do you do with all that money? Well, the first thing that happens as a result of it is you get very low interest rates in China. And as a result, they've had a very high investment rate. How do they afford all the roads and rail and airports and everything they build in China? It's because the interest rates are like 3%. But they've also got money left over. And where does that money go? Well, it goes anywhere they can find a place for it. And what they're doing with Africa is, and indeed Pakistan and Sri Lanka and Bangladesh, a whole host of lower income countries, is sending you that money and saying, look, you guys build a road and ideally use a Chinese company to do it. Maybe sell you even the Chinese cement to build the road. So we're getting to sell some services to you, but we're lending you the money to do it, but it's quite cheap interest rate because we've got too much cash. That's
and no strings attached.
The strings being that you use a Chinese company. The strings being that you use a Chinese train. And that you eventually pay back the cash.
Sure.
You know, there is that string too.
If not, we seize some of your assets.
You've seen a bit of that already in Sri Lanka.
Sure.
There's talk about that in some other countries as well. But I think there is a second part to this story, which is that the richer Africa gets, the more demand Africa has for imports. Imports from who? Often from China. So China then is helping create its own export market by building the infrastructure. And they, I think, are helped by being a bit closer in terms of their economic development. It was only 20 years ago that China had the most poverty in the world. They've really shifted dramatically from a rural subsistence farming type story 30 years ago to something much higher value added. But there is memory there. People know what it was like to be trying to build a business when you're getting off subsistence farming, a big agricultural dependency, and moving into other sectors. And so I think they can relate their businesses to the needs of Pakistan or Bangladesh or Sri Lanka or Sub-Saharan Africa.
And I like the fact that you brought out this issue of fertility rate. Africa has very high fertility rates. At the same time, we're also seeing the lifespan has sort of increased. And what's the connection when you look at, for example, China that you mentioned, from five kids per woman to now 1 to 2, and in Africa it's averaging about 4 kids per family. And we recently did our census. We are still waiting for the numbers.
Yes.
But as we stand, we are now heading north of 49 million population. And of course, the fertility rate plays a big role from what I'm gathering from your sentiment.
This is what we've been trying to understand. Is partly, why does China have all that infrastructure? Why can they afford to have the electricity and the roads and the ports and so on? And why are interest rates so high here that it becomes quite expensive? If you build up too much electricity here, it sits there waiting for factories to come. The factories will come when there's even more electricity, and you're having to pay high interest rates for that. And what it seems to be is this connection with the number of kids you have. The countries where it's under 3 children have a big jump in the amount of money put into banks. So if today deposits in the banking system is about 30% of GDP, so let's say the Kenyan economy is 100 shillings. 30 shillings are sitting on deposit in the bank. In China, by that way, that would be like 150 shillings for every 100 of the economy. So they've got loads of money. But what we think is going to happen is that as the Kenyan economy doubles to, say, 200 shillings in the next 10 years, equivalent, then the share of lending, of deposits in the system, the bank deposits, go up to about 120 shillings. They'll go from 30 to 120. We're going to see the banking system grow 4-fold, maybe in the next 10 years or so.
And for Renaissance Capital, perhaps what opportunities now lie with all this positive sentiment in the continent?
Well, the positive sentiment, you've got a positive growth story. GDP is doing better in Africa than it did the last time commodities crashed in the 80s. Definitely doing better. We can see that in the figures. But international investors are, at least on the equity side, being quite cautious at the moment.
Mm-hmm.
They're not excited by South Africa growing 1%. They're not excited by Nigeria growing at 2%. Population growth in Nigeria is 3%. And this has been going on for 4 years in Nigeria now. So you've had negative per capita growth in Nigeria, negative per capita growth in South Africa, 2 biggest economies in the continent.
Mm-hmm.
So investors have been a bit cautious and are throwing their money more into these Vietnamese type industrializing stories. What I think is going to, I think there's a number of things which people should be looking at. Firstly, if the American government's given me 1.5%, if the German government, I have to pay the German government for them to borrow money. I have to pay them for the right now. They've got negative interest rates. So I think the interest rates available in Sub-Saharan for foreign investors is quite attractive.
Mm-hmm.
I think people should be looking at buying bonds here, not just the dollar bonds that are, say, 7% interest rates, but some of the local bonds. Ghana is 15.5% for 1 year. I think that looks quite interesting for investors. So I think they should be paying more attention to Egypt, what they are, and Ghana, Kenya, and some other countries as well.
All right. And finally, speaking about this nexus between fertility and GDP growth, of course, there's also the new global dynamic that is consumerism, which is sort of giving manufacturers a lot of prospects to invest in Africa.
Yeah.
Of course, it's a game of volumes.
Yes. And it's taking a long time. I mean, I can't remember the exact figures, but Bosch were telling me what country size, what market size they needed to set up a factory.
Mm-hmm.
And they were saying even South Africa's market, with 6,000 per capita dollar GDP, wasn't quite big enough for them. So, or at least not big enough to expand. So the market's not there yet, but it becomes a kind of a positive circle. That when the electricity's here, the factories come in. The more factories come in, the wages go up. As the wages go up, there's more demand. And that then encourages more factories to come in to sell to that rising demand.
Mm-hmm.
And that story of where's the demand going to be in 2030, 40 or 50, 2 billion people in Africa 2050, this is where the bulk of the young people in the world will be.
Mm.
And it's young people who like to go out and buy stuff. By the time you get to my grey head age, we're kind of done. But, young people are the ones where the demand comes from. And that's
Certainly, yeah.
That's where factories will have to move here. They will move here, and they're going to move here in a big way once the electricity numbers are high enough.
All right. Speaking about German company, that is Bosch, I just returned from Berlin a few days ago, and I was sitting with the Chief Markets Officer, Matthias Gintham, just talking about some of the prospects that Africa does offer. And Egypt.
Is that Bosch? Is that the same guy?
He's the same guy. Yeah,
amazing.
quite a coincidence. But the Germans are really keen on getting into the African market through Egypt being their gateway, now cascading downwards.
Yeah.
But it seems to be the common thread cutting across, even when you look at the equities and the stock markets.
What, Egypt being this gateway?
Yeah.
It's because in 2010 something brilliant happened in Egypt, which is their adult literacy rate crossed 70%. Before then, it was too low, couldn't industrialize. Since 2010, it could. Of course, no one puts a factory into Egypt in 2011 because Arab Spring kicks off and it's just too volatile. And the last 10 years has been very volatile in Egypt. But it looks like that's calming down a lot. And they've got 10 times the electricity per person of a country like Kenya or Nigeria. So you can set up a factory there. And the minimum wage is $120 and so on. And there's an awful lot of positives about this place from a foreign direct investor point of view. So I think Egypt is going to industrialize. Morocco's already doing it in North Africa. Tunisia could be doing better. Egypt is going to be the big game changer. So I think this is the second wave of African industrialization. The first wave was South Africa, Zimbabwe, and Mauritius. The second wave will be North Africa, with Ghana maybe, because they also meet the criteria. And then the third wave, my guess, is going to be East Africa, and it's going to be Kenyan-led.
All right. Interesting. And we need to wrap this up. We are out of time. And, of course, Charles Robertson, I want to just get your parting shot in terms of what sort of risks do you also see in the midst of all this positive vibe that the continent is attracting?
The risk is that that there's a few years before the electricity story before all the dams have been built in Uganda or Tanzania or Ethiopia for that matter, where the electricity's not there yet, where the growth remains dependent on commodities. It's not going to make people wealthy, but it's where the revenues still come from. And the risk is that governments borrow too much during this period, and that there is another set of problems, much like Latin America had in the early 1980s, when they were at a similar level of development, a similar stage of development. And that was the Latin American debt crisis of the 1980s. That is worth being wary of. And hopefully policymakers will look back to that period and say, we're not going to make that mistake. I think that's what's happening in Kenya today with the budget. And I think that's about saying we're not going to make the mistake of borrowing too much. And we can look to Zambia, which has had all sorts of issues recently. We can look to Mozambique, which has defaulted on its debt already.
Sure.
We don't want to go down that route.
Right.
And it requires politicians to be more responsible than they always are, than they sometimes are.
All right. Thank you so much, Charles Robertson, Managing Director, Renaissance Capital. Such an honor to have you on the program.
Pleasure.
And we hope to invite you some other time.
Yeah. Well, thank you very much for having me. It's very kind.
All right. Well, we've been speaking there to Charles Robertson, the MD for Renaissance Capital, just giving us some interesting highlights in terms of what the African continent has to offer, especially now with a lot happening in the markets and many countries diversifying from relying on commodities to literally trying to open up their economies. Well, that brings us to the end of this week's episode of The Trading Bell. My name is Agina. Thank you so much for your valued company. See you next week, same time, but a different guest.